Today we're completely cracking the code on one of the most famous, yet honestly heavily misunderstood price action signals out there, the DOJI candlestick. If you've been trading for any amount of time, you've definitely seen them, but today we're going way beyond just pointing them out on a chart. We're going to demystify this whole complex world of DOJI candlesticks and actually equip you with robust, step-by-step strategies to trade them. Okay, let's dive into this. Because a doji, it's far from just some boring little cross or horizontal line on your screen. No way. It is literally the visual aftermath of a massive bloody market standoff. Think of it as the exact footprint left behind when buyers and sellers perfectly tie. To get you trading these effectively, here's our game plan. Section 1, the epic tug of war. Section 2, meeting the doji family. Then, in Section 3, we're debunking the reversal myth. After that, we hit the actual tactics. Strategy 1, the hit and run, and Strategy 2, pivot point continuation. Alright, let's get into it. So, kicking things off with Section 1, the epic tug of war, understanding market indecision. By definition, a doji forms when the open and close prices are perfectly, or at least almost perfectly, equal. But think about what that actually means in reality. The bulls pushed the price up with absolutely all their might, but then the bears stepped in and violently rejected it. Then the bears forced the price down, but the bulls dug their heels in and pushed it right back. So at the end of the session, the candle closes exactly where it opened. This tiny little candle represents a massive, unresolved tug of war. So the ultimate takeaway here is market indecision. It's a temporary lack of control from both sides, but hey, here's a critical pro tip. Just seeing a bunch of small, tight candles on a chart, that doesn't count as a true doji. True indecision actually requires context. It really only matters if it happens after a clear price movement or, say, near a key technical level. Context is absolutely king here. Moving right along to Section 2, meet the doji family. Let's quickly look at the different types of doji candles. You can kind of think of this as a family tree. First, you have your common, or plus sign doji, which is your standard indecision marker. Then, there's the long-legged doji. Now this one has massive shadows. It signals immense, highly volatile indecision, and honestly, it throws off a lot of false signals, so definitely be careful with that one. We also have the dragonfly, the gravestone, and the incredibly rare 4-price doji, which is literally just a horizontal line showing a total market freeze, usually when things are super illiquid. And this brilliantly illustrates the two most powerful variations side by side. The dragonfly doji on the left shows a bullish rejection. Basically, the bears tried to crash the price, but the bulls pushed it all the way back up to the open. And on the right, the gravestone doji is a total bearish failure. The bulls rallied, but the bears slammed it right back down. The visual shape of those shadows, it tells a very distinct story of exactly who is winning the struggle. Alright, Section 3, debunking the reversal myth. Because guys, it is absolutely not guaranteed. Time for a major reality check. A doji is an early warning of impending exhaustion. It is absolutely not a guaranteed market reversal. Trading a doji by itself, just kind of floating out there in the middle of a chart without any nearby support or resistance, that's a surefire way to lose your portfolio. You're basically just guessing at that point. I absolutely love this quote from Steve Nissen. He's the guy who actually introduced Japanese candlesticks to the Western trading world, by the way. He notes that doji candles tend to be much better at indicating a change in trend when they occur at market highs rather than market lows. And why is that? Well, because for an uptrend to continue, you constantly need new buying power. But a downtrend can just keep falling on its own weight without much effort at all. Keep that in mind next time you try to catch a falling knife. Which brings us to Section 4, Strategy 1, the hit and run. We're going to be exploiting whipsaws. So this strategy uses a specific pattern called the harami cross. What we're looking for is a standard plus sign doji that's completely contained inside the previous candle's trading range. But unlike rookies who try to use this to predict some massive reversal, we're actually going to use it to enter in the direction of the trend by exploiting false breakouts. We're hunting for a highly probable whipsaw recovery for some quick, short-term profits. Okay, so here are the exact mechanics for a long setup. Step 1. Confirm the price is advancing consistently above a simple 14-period moving average. Step 2. Spot a doji that forms completely inside the lower half of the previous candle, right near that moving average. And step 3, and hey, this is where patience really pays off. Wait for a false breakout below the moving average. Let the aggressive traders get stopped out in the whipsaw first. Now, before you risk your capital, you have to have strict rules. Once that whipsaw happens and the price recovers, you enter long the exact moment the price passes back above the doji's open and close level. Then you place your stop loss strictly below the current daily low. You set a profit target just about the pattern's high. Remember, this is a strict in and out operation, folks. Limit your risk, take your quick profit, and run. Let's move to and see how this builds into Section 5, Strategy 2, Pivot Point Continuation, focusing on accumulation zones. Instead of trying to heroically guess market bottoms, which we all know rarely works, we're going to look at dojis as accumulation zones. Think of them as basically breathing room for the bulls or the bears to gain momentum before continuing the dominant trend. We're waiting for the market to rest near crucial levels rather than fighting against it. Here's the exact setup for this one. Step 1. Spot a doji forming directly on or at least very near an established pivot point or a key support and resistance level. Step 2. Don't enter just yet. Wait for the next 1 to 3 subsequent candles to form. And step 3. You absolutely must confirm that one of these subsequent candles strictly closes above the high of that initial doji. That closing high, that is the ultimate filter. It's your undeniable proof that the trend is in fact continuing. So the crucial point is how you actually execute this safely. You set your initial stop loss just below the low of the doji. As the trend continues and starts generating profit, you continually trail that stop loss upward. Oh, and this strategy pairs beautifully with an added filter, whether that's a moving average or a stochastic oscillator, just to give you that final confirmation that the main trend is still completely intact. Well, we've covered the psychology, the family tree, debunked the myths, and walked through 2 battle-tested strategies to actually exploit this indecision. So I'm going to leave you with this challenge. Pull up your trading charts right now. Can you spot the hidden tug of war happening today? Look for that doji, wait for the actual confirmation, and trade the reality, not the myth. Thanks so much for joining me on this explainer, and I will see you next time. This image is for illustrative purposes only. To gain a deeper and more structured understanding, join my community where you will have access to comprehensive materials and detailed guidance.